Introduction. Project overview. Project title for this project is Feasibility Study for New Private College under Sunway Berhad. Budget and timeline for this project are M31 million in 5-year time frame. Key stakeholder, client, contractor, architect and government. Strategy alignment support Sunway grow in education and sustainability development. Objective for this project is determine optimal construction method, prefab, modular and conventional, balancing speed, cost and quality. Second, strengthen finance management and risk assessment for mid-range project. Third, incorporate ESG principle, sustainable material, energy efficient and design. Key analysis and deliverable, life cycle cost estimation, construction cost, operational expenses, potential ROI, feasibility tool, work breakdown structure and benefit cost ratio. For sustainability focus, eco-friendly material, energy efficient campus design, complying with Sunway ESG targets.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Nabi Bahiri. For this project, I will present about the company performance analysis. Company performance analysis is a methodological review of the effectiveness that an entity has reached its strategic objective and operational goals through analysis of primary financial and non-financial criteria. This is the analysis which normally use critical financial statements like balance sheets, income statement and cash flow statement to quantify financial performance, where performance is measured in terms of revenue growth, cost control, asset use and cash management. Balance sheet. Balance sheet is a detailed view of the financial state of a company at any one particular time, showing the company asset, liability and equity. It represents the resource possessed by the company, asset, the obligation to the creditor, liabilities and the remaining interest of the shareholder, equity. Income statement. Income statement, known as the profit and loss statement, provide a detailed summary of a company financial performance over a specific period. It outlines the company revenue, expenses and profit or losses, offering insight into its operational efficiency, profitability and ability to generate return for shareholder. Cash flow. Cash flow statement is a financial report that details the actual inflow and outflow of cash within a business over a specific period. It is divided into three main sections: operating section, operating activity, investing activity and financing activity, providing a clear picture of how cash is generated and used in daily operation, investment and financial decision. For this project, we use a Sunway Statement Company Financial Report to analyze the company performance. So this is the balance sheet for Sunway Company as at 31st December 2024. On December 31, 2024, the company's asset grew to 31.55 billion from 28.58 billion because of more investment properties, inventory and cash balance. Its total debt increased to 15.57 billion from 13.58 billion due to more bank loans. Owner equity went up to 14.99 billion from 13.85 billion because of more shares and savings. Lastly, the value per share also improved from 2.15 ringgit to 2.25 ringgit, showing the company is growing. Next, this is the income statement for Sunway Company as at 31st December 2024. For the year ending December 31, 2024, Sunway Berhad revenue grows 28% to 7.88 billion. Profit before tax increased 53% to 1.52 billion. Operating expense also increased by 38%. Strong earnings from partner and more finance income helped net profit growth 50% to 1.28 billion. Earnings per share went up to 16.74 ringgit, showing better profitability. Despite higher tax and cost, the company had strong overall income growth and good financial result. Next, this is the cash flow statement for Sunway Company as at 31st December 2024. The company made 1.57 billion cash from its operation up to 459.9 million last year. It spent only 26.3 million on investment, much less than 558.4 million the year before. The company got 572.5 million from loans and selling shares more than 415.9 million last year. Cash in hand more than double to 4.33 billion, showing the company has good cash flow. Lastly, the liquidity and financial strength. The The company has 12.95 billion in current assets and 9.92 billion in current liabilities. Its current ratio is about 1.31, meaning it can cover short-term debt with its asset. It has a strong cash balance of 4.36 billion available for immediate use. The company generated 1.57 billion cash from daily operations. Overall, it can easily handle its short-term financial needs. For the financial strength, the company has total asset of 31.5 billion and total liability of 15.57 billion. About 49% of its assets are financed by debt, which is a moderate level. Profit before tax increased 53% and net profit rose 50%. Earnings per share improved by 45%, giving good return to investors. The company managed its interest costs well despite borrowing. It used debt to grow but keep strong cash flow to maintain financial stability. That's all from me. Thank you.
Assalamualaikum and hi, my name is Muhammad Fauzan bin Azizan and I will be presenting about the benefit cost ratio for site A. So firstly, we have to determine the value for the market value, operation and maintenance, and also the benefits. For the operation and maintenance and also the benefits, we have to sum up all of the value from the first year until the 5 years. The calculation is then continued with the benefit cost ratio, where we conduct our study period for 5 years with the interest of 15%. We use 4 different equations and we can conclude that we can accept the project if the ratio is greater than 1.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Rafan and we presenting pada benefit cost ratio for site B. So as we can see here, the market value for the site B is 90,112 ringgit, and then for the value of operating and maintenance is the total cost of the first year to the 5th year. We continue with benefit cost ratio. So as mentioned earlier, we use 5 years of study period with 15% interest. We could accept the project if the ratio is more than 1. But for the conventional BC, it seems that the value is smaller than 1. So that means this project will not be accepted.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Izzuddin bin Zainuddin. My matrix number is DF220148 and I will continue from the BCR calculation, which is justification. So our group decided to choose the site A since it has a lower capital cost, which is 4.3 million can save a lot of allocation of fund to improve the facility and reduce the loan size. After that, it is faster project completion, higher net present value because the BCR calculation from the site A is higher than the BCR calculation from site B, and then the sustainability advantage, strategic location because it is better accessibility, increase future student enrollment potential, and help them with the improved facility with the remaining budget, and lastly reduce the maintenance cost. To support our justification, we use a 7 principal economic, which is start with the developed alternative to site we analyze, and it is favor to the site A. After that, focus on differences. We compare both sides based on the lower cost and the faster prep. After that, use a consistent viewpoint, evaluation based on the Sunway financial and development perspective. Next is a use common unit of measurement, which is a ringgit Malaysia. After that, consider all relevant data, including sustainability, financial returns, and the long-term maintenance. Next is the make uncertainty explicit. So we remove the PCR under 1, which is a site B, and then lastly we visit the decision, which is a site A, because decision reconfirmed through the assessment and financial alignment.
Conclusion: the choice of construction method for the new private college, whether fabrication, modular and conventional, require a multi-dimensional assessment balancing cost, timeline, sustainability and regulatory compliance. Stakeholder, investor, architect and builder must collaborate to ensure the selected approach optimize resource utilization, minimize waste and align with the RM21 million budget and 5-year timeline. Critical factors include material availability, labor supply, logistical feasibility and long-term maintenance costs. The decision will directly impact structure integrity, operational efficiency and overall project success.